Good day, guys. Welcome to Forex Walker. Welcome to episode 97. And in this episode, we're going to be previewing the trades that materialized and the trades that did not, and the reason why they did not materialize. I have mentioned some of those reasons in the previous episodes. It has to do with the war in the Middle East and the US proxies uh, in the Middle East, and as well as the South China Sea and the US proxies in Japan, Malaysia, Philippines, South Korea, Australia, New Zealand. So those U.S. affiliates are getting fuel or crude oil from the Strait of Hormuz, which Iran happens to have closed due to the conflict with the United States and Israel. So this is the CAT CHF, and the reason why I believe that this trade will actually continue to move higher. That reason is because remember the last trade that we took was over here, and I spoke about how much I believed in the trade proceeding even higher. So this was the previous trade that we took, and it actually paid off and the profits were undeniable. So over here we have the same correction that we had over here, and the reason why I believe it will continue to pull higher is because the conflict in the Middle East works in this fashion. Whenever the Strait of Hormuz is closed, this thing happened actually previously with Russia when Russian oil was sanctioned. Canada when in 2022 when Ukraine Russia war ensued. What happened was that Russian oil was this is geopolitics, by the way. Russian oil was sanctioned by the United States, and the alternative became Canada. So the I went long on can on the currency of Canada. So that's the boost that I believed in, and the trade materialized. So right now, at this moment, I have a bullish move that paid out, and we have a correction. And I believe that what happened here, this correction here, will repeat itself over here. We'll get another leg that will actually get to take profit level. So in that regard, okay, I don't remember where this line was. Okay, this line was actually showing what happened, my what my expectations were. So this move will continue because the West, Europe, sees Canada as an Canadian oil as an alternative to uh, the crude oil in the Middle East. Even though the United States president decided to remove all sanctions on Russian oil, and not so long ago they removed all sanctions from Iranian oil. So this will be our alternative. This is CAT CHF. We have other currencies that we went long on. This is also another trade that I went long on. This is USD CHF, and I have reason to believe that the trade will continue, even though I'm a little bit reticent toward the United States being involved in this war. The US dollar is a safe haven. We know that most hedge funds are going to be buying the US dollar as a result of this conflict. So they'll be looking at the US dollar as a safe haven. So the reason why I believe this move is not sustainable is because the United States is directly involved in this war, and most of the things, the heavy lifting, is done by the United States military, and less by Israel. Israel is actually doing very little lifting. The United States is doing more. So uh, its direct involvement is the reason why I don't really believe this trade will be sustainable. Nevertheless, I will be going long on the US dollar as a safe haven, and the trade continues to move higher. The euro took a while. This is Euro CHF. The euro took a while before it gave us a bull move, which I believe it is not sustainable, as normally most countries have about 30 days of uh, oil reserves in their countries, uh, and we are almost 30 days later after the conflict in the Middle East, and that's the reason why I believe that this move will come down, collapsing as those repercussions of the Middle Eastern war start to be priced in, and that's the reason why I believe that whoever is holding long the Euro CHF, you should move your stop loss into profit. And when you get another bull move, my stop loss is currently over here. And when you get another bull move, you can move your stop loss higher, because this thing will come crashing down, because of this is the economic reports being priced in, but we still have a conflict that will be priced in, and as a result of this geopolitical war being priced in, this thing will give you a huge pullback. And for you to save yourself, just move your stop loss into profit. And one day you will wake up and you'll find out that this thing went all the way down. So this is the euro CHF longs that we're holding, and we'll see when the Middle Eastern conflict is being priced in. When it does, you will just wake up in the morning and you will find out that your stop loss was hit in profit. So just lock in those profits to make sure that when the market goes down, it stops you out in profit. This is our third trade. Remember the JPY trades took off without any issues. So these uh, CHF trades. So this is NZD CHF, and I was expecting the market to actually pull back all the way down here. It did not do that, and if it does pull back all the way down here, then I'll be satisfied with a bull move taking our direction. Unfortunately, it did not do that, and I normally a huge takeoff like this one, I take it as volume. And when you get that pullback, I actually expected to break a few lows down here. And once we break those lows, remember I trade Wyckoff schematics when the market is correcting, and Elliott wave when the market is trending. So at the moment here, what we have, this is the weekly time frame. The market failed to break these lows. We did get volume. It failed to break these lows. And let's walk out of this one and check exactly what the reasons are that perhaps made us come to this conclusion. Now here we have the Chicago Mercantile Exchange. I don't know whether they call it mercantile or mercantile exchange. This is the COT report that I use for myself. So this is let's look into the asset manager or institutional positions that are being taken by the hedge funds. So at the moment, you can see that the longs, the percentages of the longs, at the moment you have 13.6% of longs, and the on the shorts you have 48.1% in the shorts. That means the asset managers or the hedge fund managers are taking more longs than shorts. Now, who are the traders? The traders, we have about 12 traders who are taking longs, and we have 14 traders who are taking shorts. Now, those numbers are very important because they tell you about the commitment of traders. Now, the current positions that we have 1,929 that are being closed. Remember, the main positions are 8,731 in the longs, and their closing positions of 1,929, and they're closing more positions in the shorts. And but if you need to measure it in percentages compared to 30,000 positions that are being supplied, and the closure of 17,000 positions. So you need to measure them in percentages if you want to see whether when they're closing both longs and shorts, uh, which direction are they weighing toward. So at the current moment, as you can see, they're closing both. Normally, when they close both longs and shorts, they're about to change the directional bias. So for you to know what the directional bias is, you need to get into the history. And I'm not going to be looking into the history at the moment and to see whether they were in an uptrend or in a downtrend. So I just ran out of time at the moment, and I'm just showing you that more positions are in the shorts than in the longs, and the participants in the shorts are 14 compared to 12. Let's move back into the markets. Let's get to this is the weekly. Let's get to the weekly is telling you that everything is bearish. Uh, uh, in the same direction as the COT reports. Let me just move away these lines out of the way. So what is happening here is that you can see that let's look at the monochromatic part of it. You can see that the lowest point was over here. The lowest we went was over here, and the market took off without volume actually. So it took off, and this is what was my first high. So it took off without volume. It came back down here, and then it broke the 50% feet, and then it went down here, did not break this low. Remember, this is Wyckoff schematics. So my expectations in this regard is that this market was supposed to pull higher, but it cannot pull higher because uh, the uh, the uh, the lady called Dr. Anna Brahman from the Reserve Bank of the RBNZ, the Reserve Bank of New Zealand, was speaking about them holding rates, and uh, that they were expecting a few the repercussions of the Middle East to price themselves in, and they were talking about not committing to interest rate changes. So that could be a bullish move, but as she continued to speak with the press, what happened was that she spoke, so she was more dovish than hawkish. So what we are looking into is that there's a high possibility that they may cut rates in the future because they are pricing in the repercussions of the Strait of Hormuz being closed, and they understand that what will happen in the coming future is that they're just actually waiting for the 8th of April where they're going to be releasing the next statement. And when that happens, I believe this trade will be delayed. And those are my current stance. Even though it looks like it will go bullish, but this whole thing is sideways. It was supposed to have spiked already. So thank you guys. I will see you on the next episode. Goodbye.